Technology, diversity, wine, the redwoods, and everything in between. Welcome to the Northern California Bay Area, and one show takes you inside the real estate that makes it all happen. This is By the Bay.
Hey, what's up, everyone? Dan Anchetta back with another episode of By the Bay. I appreciate you being here, and make sure you like and subscribe to us on Apple Podcasts, Spotify, and YouTube, anywhere else that you can find this podcast. I really appreciate it if you take a moment and leave a 5-star review. Always helps us and other people to find the show. We've been doing this weekly now for almost a year, and I just really appreciate any feedback that you have. And I want to welcome our guest today, Matt Larrabure from RBC Wealth Management. Matt's been my best friend since 7th grade, my financial advisor, and just a really great friend. So excited to have you on the show. I can't believe we haven't had you on yet. Honestly, I was like, how did that happen? I don't know, but that's okay. So you're with RBC Wealth Management. Give us the backstory on how you got there.
Yeah, so thanks, Dan, for having me. Always got a shout out. It's Dan's birthday today.
That's right. It is my birthday today. Today is May 18th. This will be airing tomorrow.
So
and it
happy
is my
birthday, Dan.
Thank you. Appreciate
on that 5-star review. Say happy birthday, Dan.
Yeah. That's a great present. Leave me a 5-star review.
There we go. Like it. So thank you for having me on. I really appreciate it. I don't know why. Maybe you didn't like my haircut before. Maybe
I
that's
know.
why.
The hair's looking good, man.
It's getting in
Matt
there.
was doing like shaved head for a long time, and like now he like fully grew out. It looks
I
looks
grew
nice.
up a little bit, an adult.
And I had that haircut, and now I've got
now
this.
You got the long.
Now I've got this.
Yeah.
Anyway.
So been in the finance industry since 2007. Started with Merrill Lynch up in Santa Rosa. Lowest on the totem pole, just kind of a dock controller, cashier.
Customer service, right?
Yeah,
You're like taking
front
people's
desk
deposits
person.
and stuff.
Exactly. And I said, this is a great industry, but this job is terrible. What else can I do? Get registered. Great. What's next? What's next? What's next? I hooked up with a team of advisors down in the Mill Valley, Merrill Lynch office, and we melded really well and said, hey, I want to do this industry or this job career for the rest of my life,
right.
rest of my career with you guys. And they said, we love you too. Our clients love you. Let's make this
go.
happen.
Yeah.
Long story short, I worked out of a Bank of America branch for a while.
Right, because Merrill Merrill sold or was sold to. Yes.
Bank of America, air quotes,
yes.
B of A bought Merrill Lynch.
During the financial crisis, 2008.
2008.
Right.
A lot of good, a lot of bad. In my opinion, that's why I'm no longer there.
Right.
But it allowed me to set up a Bank of America branch and get a massive amount of exposure to a wide range of clients and people.
This is all in Marin County, California,
Yep.
so a very affluent, wealthy area.
Yeah.
So a great place to be fishing from.
You never knew who was going to walk in the door. The
Yeah.
person that looked like the ratty jeans and the clunker
richest
car,
people. Yeah.
that has $10 million in their checking account.
Totally. When I worked for a regional bank here, people would guy pulls up in an old pickup truck, and he's the richest guy in town.
Yeah.
It's like you never know. Like you can't judge a book by its cover. And then the guy who literally pulls up in a Lamborghini, overdrew his account.
Yep.
It's just wild. Anyway,
fully leveraged. So in 2019,
right.
We left Merrill Lynch and opened the office of RBC Wealth Management in Marin in Greenbrae. RBC, Royal Bank of Canada, we're part of the U.S. Wealth Management division of RBC, the broader bank.
Nice.
So it's a great institution, a large institution, yet we are part of the U.S. Wealth Management, which is much smaller. So it's this local feel, small brokerage house feel, but a large backing. So we have all the large services that you would ever need or want, but this local feel in the sense of, I need support with somebody. I pick up a phone call. The manager says, hey, Matt, how's it going? What can I do for you?
Yeah, that's great.
Versus at Merrill, it was what did I do wrong? The manager's calling me.
Right.
It's
exactly.
totally backward, totally opposite for the good.
Now you don't have to stress about that. So you can just help your clients and service them and give them all of the benefits of the large brokerage house with the local touch and feel, personal service, and so on. So tell us about who your clients are. Not specifically, obviously, you don't need to name drop anyone, Matt.
Dan Anchetta.
Yeah. Besides
you already
me,
said it.
yeah, I did. So besides me, who are your clients? What range of assets? And tell us a little bit about the types of clients you're servicing.
Yeah, thanks for asking. Normal people. That's our clientele. Normal, hardworking people that have accumulated wealth and don't know what to do with it and don't know how to save. They've hit a point that it's like, okay, I've saved, I put money away, maybe it's through retirement accounts, I have this, I've worked here, I've maxed out my 401k, I'm making $300,000 a year, me and my spouse, and now we don't know what to do with this. I left this job, I'm working here, Sometimes, a lot of times, it happens through a life event of a death. I've inherited 100, 200, 500,000, a family house. Now we sell it. What do I do with this money? So the majority of our clients are, if I had to really pinpoint it, over 40 that make $100,000 to $300,000 a year plus. Anywhere, the majority of our clients have 500 to 10 million, 500,000 to 10 million in investable assets. Okay. That's our range. And it's like, wow, that's a big range. But that range has a lot of commonality of type of personality, type of people there. A lot of times they've built that wealth, and maybe they've inherited some as well, but they've built that together themselves. Nice. It's not this generational trust funds that are 50 million that are just accumulated and people just spend it, right? It's they have a connection with their own money, and they want to make sure it's working for them, for their retirement, their goals, and potentially their next generation.
Nice. Okay, cool. That makes a lot of sense for that market, and cool. Thanks for that context. So, the focus of this show is all about Bay Area real estate, which is a wide range, and there's all sorts of different sub-markets and niche markets there. But they all kind of depend on a few things, right? Like rates, mortgage-backed securities, and just kind of what's going on in the job market and job growth and wage growth and all that stuff. So give us some insight from your perspective as a financial advisor. You're obviously studying markets and watching things as they're happening in real time, so you can give quality advice and making sure that your clients' assets are protected. So talk to me about what's going on in the rate environment, with treasuries and other things, but break it down for everyday people who are watching this that are just wondering what are rates going to do, where are rates and what are they going to do?
How much time do we have?
Just a few minutes.
Yeah, exactly. Yeah. So rates are very complex. When we hear of the Fed has raised rates, it doesn't mean they raised mortgage rates. They raised their specific rates that the Fed will charge if a bank needs to fund overnight loans to fit their reserve requirement. Now I'm getting deep into the weeds, but it's important because that's the rate that they change.
Right, the Fed funds rate.
The Fed funds rate and the discount rate. Right. There's one is between the Fed and the bank, and then the other is the rate between banks that they'll charge, again, for overnight loans. Says, hey, I have these deposits, I have these loans, I have to fit this range. I need to borrow $10 billion, and I'll give it back to you tomorrow, tomorrow morning. So that's the rate that the Fed controls.
After and during the financial crisis, there was all these rules put on banks that they had to have a certain amount of liquidity and have certain ratios of assets, deposits to loans.
Right.
And so if you have not enough deposits, and too many loans or other liabilities, non-cash holdings, you have to borrow overnight so that when you do the math, you're in the range.
Correct.
And there is a fee that a bank charges another bank if they have excess deposits.
Correct.
And a fee that the Fed, charges a bank if they need to borrow from them.
Exactly.
Right?
Yep.
And those are the rates that they're changing.
Correct.
But changing those rates changes other rates.
Exactly.
Okay, so go into that a little bit.
Yeah, so it filters down just like anything. A bank's going to charge this rate, and then they're going to pass that cost on to the consumer, and it just kind of filters through from I can get this much in rate, in savings, in loans. I need to then cover this cost by lending out at a higher rate, right? It's cost me 6% overnight. I need to lend out at 7%. Don't quote me on those rates, but that's an example.
So
I
the
need to cover that
difference
spread.
in between is called a net interest margin.
Yep.
Right? And that is the profit that the bank makes.
Correct.
The difference between their cost of borrowing and their rate that they charge to lend.
Yep.
That gap is the net interest margin.
Yep.
So as your cost of funds goes up, you have to increase your consumer rate or the rate you charge a business or on a mortgage loan or on a commercial loan or whatever it is, so that the profitability of the bank is made in that gap.
Yeah, in a very abridged, short version explanation.
Summary version. We're not going to get into derivatives. We're not going to get into that stuff. But that's the basics.
Exactly, and that's why you see then your interest that you get on your savings accounts go up as well. Right. Banks are charging more for their loans so that they can offer you more on your savings.
Understood.
Right, to attract those deposits. So then they don't have to go to the Fed or the other bank to cover those loans overnight because they want to attract those deposits.
I saw something like a 4% CD, something like that, a certificate of deposit that's safe. That's under the FDIC threshold. It's fully insured. There's no risk, right? In theory. That's like at 4%.
Yep.
And that like a year ago or 2 years ago was less than 1%.
Yeah.
It was like maybe 0.5%.
If you're lucky.
Right.
Yeah.
So basically that's saying that, hey, we're borrowing from the Fed at 5.5%, right? But if I can get a consumer to give me the money at 4%, that lowers my cost of funds, right? And so the best thing for businesses or for banks is to have like checking account deposits that make no interest.
Yes
right?
and no. Yes and no. Because what the bank can loan on actually is different between a checking account, a savings account, and a CD, right? That percentage. So if you have $100,000 in a checking account, maybe they can only loan out $10,000. I don't know those numbers.
Whatever that is.
But
Lower
a savings
percentage.
account might be 20, and a CD might be 50.
Right. Because the likelihood of it leaving in transactions.
Right. So it sticks on their balance sheet and better.
This is the issue. One of the issues that some of these bank failures have had is that they had liquid assets or liquid deposits that were there that left in by the billions.
Yep.
And then caused a liquidity crunch, which forced them to borrow more at a higher rate,
right?
Shrinking their net interest margin,
yep,
and basically making them insolvent.
Yeah, it's unsustainable, right? That point, they hit that point of this is not sustainable. This is not survivable.
Yep.
It can't continue. Bank failures happen in a couple different ways. SVB versus WAMU back in the financial crisis. There's a lot of intricacies there. I don't think we have hours to go into that, but it does affect the overall consumer market, right?
Right.
You have bank failures. It's a risk. Okay, why the Fed, the government, they're all looking at why did this happen? How do we prevent it from happening?
Right.
Maybe we need to be more restrictive on our lending practices. And so that makes it harder for consumers to borrow, makes it harder for businesses to borrow, and it all filters through.
It's one of those unfortunate things where, like, take the WAMU example. Like, they were doing crazy stuff.
Yeah.
Right?
Right.
But then in their wake, they left all of this regulatory burden for everyone else who wasn't doing crazy stuff. Now they have to meet that burden. It's like, well, why didn't we just stop them from doing it? Right? They're all out of the business. They all made their millions and billions. But the people who are doing business the right way and always have are now tasked with this huge burden of compliance and regulatory and ratio. And it's like, guys, why are we managing in the rear view mirror? Like, it is predictable that if you're doing a third mortgage with no asset verification, no income verification, and no appraisal, like, that's gonna be a problem.
Yeah.
Like, that doesn't make any sense.
Right.
But we do it.
Well, what happens, I think, is you have a product or a solution for a very specific market, very specific
like
niche,
the self-employed borrowers
right.
with the no income verification because they're writing off all their stuff, but they might make a ton of money. They're just writing everything off.
Right.
That solution makes sense for that subsection, but then you open it up to everyone.
Yep.
And then you've got people who are fabricating income and being very optimistic of what they're going to make.
Sure. And
what they wouldn't lie.
Right.
Their
projections are just
wrong.
High.
Yes.
Yeah.
And then things go bad.
Right. So then it's no, we can't. These loans are bad.
Right.
When in reality, the loans, like we said, they're for a purpose.
Right.
They're just not being used for the right purpose. Right. So that filters into what you see probably every day of like, okay, we have all these products. How do we put the person into that product for a loan, for a purchase, for a refinance? How do we make that match for what they need?
Right. So prior to being in the mortgage industry, as you know, I was in the commercial lending world, and one of the things we talked about all the time was like matching the loan type for the purpose. So like, is it short-term debt? Is it just to bridge a gap in a receivable? Is it long-term debt? Like you need like inventory, baseline inventory to finance that you're going to have you always need to have $500,000 in inventory on hand, right? So it's not like revolving so quickly. So like making sure that you're matching the purpose of the loan with the right type of financing.
Yep.
And don't take short-term funds to finance a long-term need, right? Don't take a 1-year note to finance a commercial building.
Right.
Doesn't make sense. And conversely, don't take long-term funds to finance a seasonal liability. That just makes problems because then the business owner thinks they have a ton of cash. It's like, well, no, you don't. That's just delayed money for the future. Anyway, so
I just want to touch on something. You brought up something. The terminology matching is really important, and we bring this up a lot. We match the purpose, the money for its purpose. Right? When we're dealing with a client, it's should I buy this CD? It's yielding 3%.
Right.
Well, what's the purpose of this money? We match the money for the goal that we're trying to achieve with it. Right? Just like the opposite of, oh, I have this money, I want to buy this stock. Well, what's this money for? Well, I'm going to buy a house in 6 months. Well, you shouldn't buy that stock.
Right. Highly volatile, single stock.
Yeah, it might not be there.
Right.
I use this, it's kind of silly and it's very oversimplified, but it might be the best investment, but the worst investment for you because it doesn't become best until the day after you need it.
Right.
Right? If you need it today, but it won't really do well until tomorrow, it's not good for you, right? So match the purpose together.
And the time frame and the
Exactly.
risk and all the other things. So in general, we have like a big topic of the debt ceiling that's coming up, which we need to touch on. But in general, give us a prediction. Obviously, this is crystal ball territory and not going to hold you to it. But you're looking at the macro trends. You're looking at overall global supply and other people's economies, emerging things, all this other stuff. Where do you think rates are going?
Interest rates in general on a consumer side, they'll might inch up another 1 or 2 notches, quarter percent every once in a while. Once in a while, that's a technical term.
Do you think that we've hit the terminal rate?
I think we're going to start to peak and slow down. I think economy is getting to a point, a manageable. Inflation is coming down. It's slowing down. Yeah. It isn't at the target rate of 2 to 3%, whatever it is.
Not
it's obviously
right
like
time.
6.
Yeah.
Depends on which term of inflation you use.
I know.
CPI, which one?
There's too many different ways to define it.
Too many.
Right.
Are we in a recession? Are we not in a recession? It's like, does it matter if we call what we call it? Not really. It's what is the long-term impact? Right? And how does that affect you? Right. Most of the time, there's so much headline risk, right?
What does that mean?
Headline risk. You see a headline on the news, and you freak out about it.
React to the headline instead of reading the actual...
Yeah, what does it mean for me?
I get those emails often from a client. Hey, I saw this article about XYZ. It's, a terrible time to buy a house. And it's like, okay, did you read the whole article?
Yeah.
I mean, at least read the first 5 sentences, right? Maybe don't read paragraph 19, right? But you don't need to get into the technical analysis. I don't expect that, but read some of it. But the headline said one thing, and it's clickbait. It's all you want. All you want you to do is to click on it because that's how they get paid.
They sell ads.
Right, they sell ads.
Yep.
Anyway, so headline risk meaning you can't lead with too negative of news at the headline because then people get reactive because they don't actually read what's going on.
Yeah, but that happens all the time. And like you said, I got an email the other day from a client. Debt ceiling. I'm scared about the debt ceiling issue. Let's go to cash. I'm like, okay, let's talk about this.
Yeah.
What is this money for? This is your long-term retirement account that you're touching X amount of dollars per year for the rest of your life.
Yep.
The likelihood of the entire federal government collapsing because of this debt ceiling conversation is very, very slim. And if that happens, we're probably all...
We have a bigger problem if we, in the event that we actually default, that the United States government defaults on its debt.
Full-on default. Not just like, hey, we missed a payment because we couldn't figure this stuff out. That might happen. We might miss a payment. That is a very possibility.
I don't think it'll let that happen.
I don't think it will. The government shut down one time back in 2000... What was that, 15, 11?
Yeah.
It all blends in together. And now it's a long distance. Nobody even remembers it happening.
Yeah.
These things happen. And a lot of it is political gamesmanship. It's to get people to engage, and it creates that headline risk for the clients and the people to be scared to make an emotional decision rather than a rational, good financial decision. So if you see that, if you see those kind of headlines, it's like, oh my gosh, I'm freaked out about this and how it affects me. That's a great time to talk to your mortgage advisor, talk to your financial advisor, talk to your CPA, and say, hey, what is it? How does this impact me?
What about my uncle who thinks that he knows because he's read some stuff online? Is that a good source for?
100%. The best type of stock tip is from your garbage man.
I like it. That's funny.
That's the time that the market's probably a little overheated.
That's it. So talk to me about job market. I think one of the things that we're seeing is that housing prices and overall mortgage payments are going up, right? Higher interest rates, even if prices stay the same, down payments stay the same, we're just paying more every month, right? So if you got a mortgage a few years ago, you're like, I'm the smartest person in the world because I've got a 2% or 2.5% or 3% interest rate. Look how awesome I am. Not everyone is able to do that. So overall, mortgage payments are going up, but people are still buying houses, right? So talk to me about the job market that you're seeing out there. because I'm still seeing wage growth. I'm seeing people making more money overall and still willing to spend $5,000 or $6,000 a month on a home loan, on a mortgage payment to buy the house. What is the data telling you about like the job market, and you're watching unemployment claims and sort of, I'm assuming?
Yeah.
Because those things impact the overall policy, right?
It does. And it's really difficult because I think the job market is very, there's micro, just like the real estate market, there's micro economies. And there's micro economies in the job market as well, if you want to call it that. And it depends on the type of industry and the geography of where we're looking at, right?
So like locally, we're seeing like tech layoffs and all this other stuff, but we're still seeing vacancies in jobs and they can't fill them. Like those are just getting absorbed, right? They're going somewhere. And I haven't seen much like continued unemployment. It might be a different job or maybe slightly less money or different bonus structure or something like that, but like they're getting hired elsewhere.
Yeah, there was a shift last couple of years. COVID world changed a lot of people's perceptions. There was a decent amount of people that got removed from the job market, meaning they retired. They chose not to search for a new job, right? I think that had a big impact. That doesn't really affect the unemployment rate because that doesn't.
They're not in the pool.
They're not in the pool, so they're not part of that unemployment rate. So there was people that retired early.
Right.
They got removed. Right.
There's a term for that. It's like systematic unemancement or something like that. I remember, but
there's a term for everything.
Yeah, exactly.
I can't remember
them all.
No,
and there's an acronym to define the term.
Oh yes.
But basically, they're saying like people who, to be counted in the unemployment numbers, you have to be actively searching for a job within a certain time period. So if you are disenfranchised, if your job no longer exists for whatever reason, and you stop looking, even though you're not employed, you don't get counted as part of the unemployment.
Right. So those people that college kids come back from school, living at home, not really doing anything, so those numbers are a little bit off. They're not searching, they're not in those numbers. So there's people that are unemployed or not working that might skew the unemployment number to be actually higher than what it looks like because we're really very low unemployment rate. Right. Which we think, this is great, but there's a lot of also vacancies in the job industry that there's a lot of jobs that we haven't filled. Right. You see help wanted signs all over, but like you said, we're also seeing people in the tech industry getting laid off. Right. So there's shifting going on. I know several people that are, higher upper management that are struggling to find job that they had 2, 3, 4 years ago at that level. There's shifts going on.
Well, I think every business right now, just with the things slowing down in general, costs going up, and just still having to be profitable and do that, you're having to make some really hard choices, and you're reshifting. You're shifting things around. You're renegotiating things like office rent that you don't need so much space anymore because people are working more remotely. There's all sorts of like big trends that are happening. I guess the question and the point is that there's still high levels of employment. Wages are still continuing to go up, and probably even faster with the inflation that we've had, right? To just afford things, you had to go back and make more money, which adds to the inflation, which is kind of this death spiral that we're trying to break by increasing interest rates and slowing things down. But I think one of the things I heard early on in this economic cycle was like the Fed's going to keep increasing rates until they kill the job market, and I don't know if that's true anymore. What is your perception of that?
There's a political aspect to the Fed, unfortunately, that we say that there shouldn't be, but there really is.
Of course there is. They're appointed.
They're appointed because they know that their job's on the line if they don't actually follow what they're told by the president, right?
Isn't that term coming up too? Isn't he up for another 6-year appointment coming soon?
Yeah.
Anyway.
And so there is an aspect of if you kill the job market, that's going to look bad on the president, right? It's just the way the system.
Again, headline risk. There was the FHFA, the Federal Housing Finance Authority, that oversees Fannie Mae and Freddie Mac. They're like the government sponsor entities that oversee the housing market. They changed some of the rules for how we assess risk in the loan level pricing adjustments. I'm sure you saw my videos on it. They're very good.
Of course.
The headline was new Biden policy taxes people at a higher rate for having good credit. And that's what everyone was responding to. And it's like, number one, it's not Biden's policy. He appointed the director.
Sure.
So
it rolls up.
Yes, but he wasn't sitting there in the Oval Office going, you know what I want to do? I'm going to change the loan level pricing adjustments. That it's like he doesn't even know these things exist. But it's very interesting how the news carried that, and then it was like, actually, that's not true. And anyway, there's all this analysis goes into it. But I think that their point earlier, the headline risk is really interesting and how things are politicized. So going back to the jobs thing, your thinking is that there's too much headline risk to kill the job market. So they have to be like really balanced this delicately.
And I think part of it, it's being fixed, if we want to use that, or adjusted by interest rates, right? It's solving the wage inflation by saying, hey, we're going to make it more expensive for you to hire because we're going to have your cost of borrowing is higher. So if you're borrowing to sustain your company, you're a startup company that's not profitable, you have to get money from somewhere. It's going to be more expensive for you to borrow this money, so it's going to be more expensive for you to hire this person at a higher rate. So maybe you're not going to hire them, or you're going to pay them less money. So it's going to squeeze it. It's going to keep squeezing it.
I think that's a big risk in this area, especially with all the startup, is that right now if you're a VC, like you're funding venture capitalists, it's funding startups, and you have to have a certain rate of return on that investment to make it make sense. But you can make 5% in a risk-free, treasury bond, right? Risk-free, assuming it's backed by the U.S. government. What does the premium that you have to what is the rate of return that makes it worth risking billions of dollars on a startup if you can make 5% on a risk-free asset? Like, I don't know what that number is. I think it's different depending on what the technology is or whatever you're investing in, but that impacts everything. Cap rates for rental properties, capitalization rates, and basically your rate of return on your investment. All of that math gets really skewed if you can make 5% or 6% risk-free.
Anecdotally, I have 2 clients that have small businesses. They're not in this area. They're one in Southern California and one actually in Texas. And they're small business, 1-2 employees. They both have been in talks with having a company buy them, a private equity firm buy their company. The talks have all stalled in the past 2 months. And there's, they're not, it doesn't say specifically why, but whereas 6 months ago it probably would have been, great, here's your multiple, let's do this, here's the funding, boom. It's slowed down, it's stalled, they're not meeting on the pricing because the VC firm, venture capital firm, or private equity firm wants a higher premium, so they're going to pay lower dollar for your company because they need that higher risk premium for your business.
100%.
Right, so
it lowers the value. It lowers the value of your company because they need to make a higher percentage of profit on their dollars they're investing in you.
Right, because they need that higher percentage because they can get 5% for free.
Right.
They're getting 5% right now on their cash, sitting wherever it is,
doing nothing.
They're getting 5% on it. So they need to get 8, 9, 10 plus 12%.
It depends on
their model. Right.
So pull this back into home ownership as we're kind of wrapping up here. So talk to me about, give me some advice as from a financial advisor's perspective, first-time home buyer looking at buying a home, assuming they're gainfully employed and they're kind of doing all this stuff. What advice do you have for someone who wants to buy the first home?
The first step, and I actually told this to somebody on Monday, talk with your loan professional to see what you can afford based on your current income.
Okay.
Right? You have to have that idea. It's like, I want to buy a house. Okay, well, you need to know how much you can afford.
Okay.
Right? I think that's really important to have that frame of reference.
Okay. And how do they balance that with their other investing?
Yeah. So then you sit down and say, okay, I can afford this. Is this the level of payment I want? How much down payment should I put down? Right? There's no perfect answer, unfortunately. There's no always do 10%, always do 20%, always do 50%, always do 2%.
Depends on your situation.
It depends on your situation, how much you're making, how much are you saving.
Right.
You don't want to put all of your money into buying this house. Yes, houses are good assets. Yes, they are good
in the long term
investments.
Yes.
Right. They can be very good. They can also be really bad. Right. A lot of people think, oh, this house, I want to buy a house. Actually, I want to invest or buy a house. I'm like, well, you're actually investing in a house. That is an investment.
Right.
It's not this magic bullet. It's not this magical investment that always goes up and that you instantly make money on. A lot of times you think it's magical because you get to leverage it extremely high,
right,
which is great. You can buy a house for almost 0% down, and if it goes up $1,000,
yeah.
I made $1,000 and I put $0 down, right? That looks really good, but you're also leveraged 100%, right? So back to what you were asking, it's a balance of what is important to you and what you're trying to accomplish. Are you going to be there? How long are you going to stay here? 1 year, 5 years, 10 years? We don't know, but you can help.
What's your plan?
What's your plan, right? I think that's really important. You shouldn't buy a house if you're going to move in a year. That doesn't make any sense. So what's your plan? Is it to stay here for any length of time? Am I now working from home, right? That's a big shift in the job market, working from home. So I want to buy this house that I'm going to be here long-term and comfortable in this place so I can work here. It's really this balance of what are my goals, short-term, long-term, family, all of those things. You have to talk it out versus making an emotional decision. I love this house. This is the house. Okay, why is this the house? Well, it's the first one I saw and it's available.
Right.
There will be more.
There's always more houses.
It doesn't have to happen today.
Yep.
2 months ago, 3 months ago, there was like 2 houses available on tour or whatever, right? Yeah. So low inventory. I talked to a realtor buddy yesterday, and he was like, there was 14 houses on tour in Petaluma.
Yep.
Right? That's a huge difference, right?
It's a huge difference.
So there's inventory.
And all through the spectrum of affordability and prices.
Right.
There's $3 million houses, there's $400,000 houses.
Yeah. So there's that shift, and it's, okay, you don't have to make an emotional decision to get that house. Right. That, I think, is the biggest takeaway, is don't make an emotional decision for a financial transaction.
And I think, to your point, and we'll wrap up on this, is that, in my experience, very rarely is there a conversation had with the mortgage advisor, the financial advisor, and the client on the call at the same time. Yep. If I could change one thing about the finance world that we both operate in, maybe not the first call. The first call, people are excited. They want to get some information. They want to know what they can do. They want they've had that dream of owning the home, and they've envisioned where the Christmas tree is going to go and what it's going to be like drinking coffee there, like doing that thing. Where does the TV go? The second or third conversation, if I could change anything, it would be a requirement that a financial advisor and the mortgage advisor are on the call with the client talking about how are they going to balance the desire to own a home, the overall financial strategy, and protecting the family with things like a trust and a will and life insurance and like all of those financial instruments that go into having a safe foundation for the homeowner, and not just focusing on, I really love this house, I really, really, really want it. Like, we can still get you there, but I would love for there to be a transformation of like, okay, let's take a deep breath and have a real conversation and understand all of these things that we need to put in place to make sure that your family's protected, the asset is protected, and it's in line with the overall like long-term strategy.
Yeah, that would be nice.
I think we need to do it.
We can make that happen.
Cool. Dude, we just scratched the surface, but we got to end the show here. I'm going to have you back like sometime real soon, because I feel like there's so much more to unpack with just how the economic cycles and different financial instruments and things that we see and hear about on CNBC all day impact the home ownership rates, and also just like the overall strategies that people are using to own a home. So I'm going to come up with some more like specific things, the kind of tactical things that we will dive into, and we'll have you back sometime for a Matt Larrabure Part 2. Thank you for being here, and I appreciate you and your friendship, and I appreciate being on the show.
Thank you for having me, and happy birthday.
Thanks, dude.
Stay up to date with Bay Area real estate. Hit subscribe now if you haven't already. Did you enjoy this episode? We love reviews in the Apple Podcasts app. We'll read yours on the show. This is By the Bay.
London Ear Media.
The handshake is amazing. It's a thing. You guys know each other.
Oh, yeah.
Got to do the handshake. I was thinking, we got to get the handshake.
It was awesome.
Was that?
You looked.
Did I?
Yeah, you did. It was cool.
Dang it.
You looked.